How many people are carrying a blank check in their wallet these days? Why is it that Visa and MasterCard win so much? It makes me think, though, I hear and I believe your perspective that banks are all snowflakes, right?
Look, without beating up on them, banks control the payment rails.
Welcome to Money Mavericks, the podcast where we explore the dynamic world of finance, investment, and entrepreneurship.
I'm Kirk Drake.
And I'm Daryl Hicks. Together, we're here to bring you the latest insights, expert opinions from the trailblazers who are redefining success in the financial world. I think there's probably a lot of people out there who are maybe new to credit union world and credit union service organizations, CUSOs as we affectionately refer to them. I know what PSU does. Obviously, Kirk is intimately familiar with it, but maybe you can just kind of run our guests through the quick high level of what PSU does, why they exist in the market, the problem they're solving, who they're solving it for.
So PSU started 45 plus years ago, and the problem was really credit unions individually were too small at the time to issue and process and run credit card and debit card programs. So 5 credit unions got together and said, together, we have enough scale to do this. Individually, we don't. So those 5 credit unions started PSU along with Dave Serlo, who was the first president, CEO, first employee and only employee for a number of years. And then, grew. A lot of credit unions at the time wanted to be in that space as well. So it provided them a mechanism to do that. So through our history, credit cards, debit cards has been our primary line of business. More lately, we've expanded into other areas that credit unions also need to be in. And, scale in today's day and age is super important. So we kind of provide that scale to the credit union industries.
Can you explain issuer versus acquirer, credit union perspective versus the merchant perspective, and the 82 mouths that get fed in between? Just take a couple minutes and kind of explain that piece of it, because I think it's a very complicated piece that most people don't get.
So first, simply, the issuer is the one who issues the card. So bank or credit union is the one who gives their customer or member a card. So they're the issuer. The acquirer is the one who accepts it. When you swipe your card, somebody runs that merchant terminal that you're swiping or dipping or tapping your card at. They take a little piece of that transaction for providing that service. There's some big players in the middle, Visa, MasterCard, Amex, depending on the brand of card. They get a piece of that transaction, generally pretty big piece of that. There's processors like us that do the processing for the financial institution. And so we take, a few pennies out of that transaction too. And then the issuer of the card, the bank or credit union, they do pretty well on that side from what's called interchange. So let's just take an average $100 transaction, $100, the merchant who actually sells the goods, of that $100, they'll take home about $97.50. So somewhere along the way, they're losing $2.50, and that $2.50 pays pretty much everybody else in that stream. And it compensates them for processing the transaction, eliminating or preventing fraud in that, the cost of issuing the cards. So all of that gets spread out. The issuer, they probably get the most. So they're getting ballpark out of that $2. The other 50 cents is shared by Visa, MasterCard, companies like ours, the acquirer, the ISOs that are along the way.
And the issuer in turn takes a good chunk of that $2 and gives it back to the cardholder in some way, shape, or form, right? Like the big thing that drives the choice to use Visa, MasterCard from a consumer's perspective is that obviously it's extremely convenient. They know that it's a very risk-free transaction because if anything goes wrong, they know they can just call their bank and they can charge it back. There's like a level of protection and being able to overturn fraudulent transactions. There's the prestige, right? Everyone loves like their black card or their gold card, the really heavy metal cards now, right? All private banking, black, platinum, all that stuff. But then a really big driver of it too is points, right? We get these huge rewards that are coming back, and that's a significant amount of that $2 that the issuer is collecting is they're turning right back around into some sort of rewards program for the customers. And then obviously probably the biggest driver of it all is that, especially in a credit scenario, it's allowing people to spend money that they don't have today. There's all these incentives from the cardholder's perspective, and it really starts with them. Like my analogy on this is like if you walk into a Starbucks and there's 100 people in there and you say to them, I've got this really fantastic widget and everybody in there wants to buy it. And you say, I only accept check. How many people are carrying a blank check in their wallet these days? Or same scenario, you say, you know, it's $100 widget. Everybody in the Starbucks wants what you have. And you say, I only accept cash. Right now in 2024, how many people carry $100 in cash
I will
in
tell
their
you, in the
wallet?
winery,
I mean, it's an incredibly great point. And I think that gets lost along the way is everybody talks about the merchant. In my example, you know, losing $2.50 of that transaction, but what they gain is far more significant. They get immediate access to those funds. They don't have to manage cash. They don't have to worry about bounce checks. Like there's a lot of benefit along the way. And that whole idea that people can spend money from a credit perspective that they don't have, that is a huge benefit to the merchant too.
Yeah, if you have 1,000 people coming into your website, you want to maximize how many of those 1,000 people are going to end up buying from you. Why are merchants paying 2.5%? Why, like, none of them are excited about it or happy about it? And why don't we see more like cryptocurrency and some of the other alternative methods of payment? And it's like, well, you got to understand, this is really all driven ultimately by the cardholder. They decide what it is that they want to pay with. And the merchants are like, look, I want the highest possible conversion I can possibly get. And then, like you said, there's other protections they get too, right?
Well, ubiquity is a huge thing too. I've left the house for a week-long trip without cash, anything, without cards, and just use my phone. And that ubiquity is super important to merchants too.
I will say,
Why is it that Visa and MasterCard win so much, for example, right? Why is it that even though merchants hate, or at least they say they hate a lot of times paying this 2.5%, that it still just happens and it's such a big part of our economy? Because once you start to understand those whys, when you jump over to, like, say, the FedNow rails and real-time payments, you start to understand, wait a minute, there's some really serious problems. Because you remember, one of the reasons why cardholders like to use their Visa and MasterCard is that they can overturn a transaction if there's fraud. What do we do about fraud in RTP rails? Because if something is real-time transaction, real-time settlement, like the money is gone instantly. Like that, what now, Brian?
I think so. There's a couple things. First of all, it's really important to understand the difference between real time and truly instant. So you use Venmo. It looks like that transaction occurs in real time, but the money technically hasn't moved. It's moving later. And so it's a real time transaction, but that money movement is not instant. In FedNow, the money moves the instant it's gone. And once it's gone, it's gone. If I meant to pay Kirk and I typed in Kirk Drake instead of Kirk and I paid that person, I'm reliant on their good nature to return the money and not.
I also have that account, just to be clear.
I would have suspected you would, actually. You look at the value of Visa and MasterCard, that network is super valuable. And you see that play out in the US and countries like Australia, where it's deeply penetrated. You go to countries like India, where Visa and MasterCard networks and card usage is super low. When India, as an example, rolled out their version of FedNow, QR codes and that faster payments rails exploded to the point now where it's really hard as a card network, Visa, MasterCard, whoever, to get into India because they built out that network first. And so that first mover building out the network is super important.
Yeah. Incumbent biases are very, very real and run very, very deep in payments. And I mean, look, the two most regulated aspects of Western society are healthcare and financial services, because one's messing with your money and the other's messing with your life. And we need that regulation. We need that protection. But then what happens is that everything moves so flippin' slow, and it's almost impossible for new players to come in, and the existing people become so deeply entrenched. So it's fascinating.
Every time I hear a financial institution, bank or credit union, complain about regulations, I also have to remind them it's a big barrier for entry to a bunch of incumbents. There'd be so many other players in financial services right now if it weren't for those barriers of regulation that banks and credit unions have gotten used to over time. Think of all the fintechs that would be running rampant in financial services without that barrier of regulation.
On Money Mavericks, we don't just talk about making money. We explore the innovative strategies and bold decisions that drive real change. Whether you're an experienced investor, a budding entrepreneur, or just someone looking to make smarter financial choices, we've got something for you.
Every week, we're going to sit down with industry leaders, visionaries, and mavericks who share their journeys, challenges, and breakthroughs, from contrarian views on market trends to the secrets behind building a successful startup. You get an inside look at what it takes to thrive in today's economy.
And we promise to keep it real, engaging, and most importantly, actionable. No jargon, no fluff. Just straightforward conversations that you can apply to your own financial journey.
So get ready to challenge your thinking, expand your knowledge, and take control of your financial future. This is Money Mavericks,
where we turn financial dreams into realities and mavericks into legends.
Fintech should be asking the banks, what are their pain points and what are they doing? The bankers should be asking their customers and looking at what their customers are doing. Where is my customer moving money every month?
Mm-hmm.
And how are they doing it?
I love that you call that one out. This is
and look,
directly
we've
germane
had
to what I'm working on. So
yeah, so I mean, a couple of companies that we've had through our programs, Revio Insights, Clarimus, a few others. I mean, this is where you start. It's like, if I don't know what my customers are doing, how am I going to build products and services to meet their needs?
Yeah, exactly.
So show me that they're sending money to Venmo and WhatsApp and Cash App and PayPal every month. Show me that they got money going to Robinhood. It's that kind of foundational analytics. So to your question, payments data is ultimately one of the most precious assets that banks possess.
Yeah. And, I often say one of the problems that I see from my angle is that merchants will always know more about the given risk profile of a transaction because they see things that nobody else will see, like the device that's being used, the IP address, the shopping cart contents, email address, shipping address, all these things that are currently not sent into any of the cores or any of the FIs. But then the FIs will always know more about the risk profile of a given customer, right? Because if they're looking, to your point, are they even looking? But they see everything else that's happening outside of just that one individual transaction. In an ideal scenario, we would have a harmonized, standardized way of bringing all of this together in order to build a real-time, comprehensive picture of the true risk profile, combining all that together.
So look, without beating up on them, if you take the traditional core vendors, their debit card product is running over here on the deposit system. Their credit card system's running on some third-party external system. I got ACH flowing around. How am I going to bring that together so I know what Kirk is doing every month?
Yeah, it's a really hard problem. It's a really hard lift. But that's where the real value is. So my spidey senses were kind of telling me the same thing, but it sounds like I love that was your answer. That's fantastic. It kind of related to. Go ahead, Kirk.
I was going to say, I did not set that up intentionally. That was just that.
Well, look, even back pre.com, one of the things that we've known in the banking industry, because we saw the entrance in there, I can go open a quote unquote depository account with a brokerage, with an insurance company, with all these other parties. I can get loans from lots of different people. Banks control the payment rails. They control the money movement. That is still today one of the most precious assets that is underanalyzed, underappreciated. I don't want to say undermined but it is under space mined in terms of intelligence, in terms of insights. Banks should be mining that payments data in real time, knowing where their customers are moving money, and ask that question: why are you sending money to Robinhood every month? And should I be providing some services to you to keep that money in the bank?
It makes me think, though, I hear and I believe your perspective that banks are all snowflakes, right? And that they have different priorities. But I got to believe that there's still some commonality right there. Like you talked a little bit about peer group.
Oh, absolutely. Look, it's the most highly regulated industry out there. So there's stuff they must do, right? There is third-party risk management, third-party vendor management. There's, regulatory compliance. There's quarterly call reports. All of those things they must do. It's the differentiation above and beyond that. What community do they serve? What are the products and services that they're great at? What does their marketplace want from them? How do they better serve those communities? And as I said, if you take that ag lender in North Dakota and that light industrial manufacturing lender in East Atlanta, 80% of the stuff they do is the same. 75, 80%, they have to do. It's must do, have to. But also what's interesting about that, if you look over the last few years, it's probably in those must do, have to areas that there's more opportunity than ever before to create better efficiencies. That's where a lot of the tech is focused, that back office stuff that historically we've applied brute force, manual labor, redundancy. God, we've gotten this long and nobody said AI, but can the evolution of artificial intelligent tools provide more efficiency? Because I'm going to toss this one to Kurt, because you really only have 3 levers when you're selling to a bank, right? Can I reduce costs, make them more efficient, increase profitability? That's it. I mean, that's.
Thanks for tuning into this episode of Money Mavericks. We hope you found it insightful and inspiring.
Don't forget to subscribe, like, and leave a review on your favorite podcast platform. And be sure to share this episode with someone who needs to hear it.
Stay connected with us on social media and visit our website for exclusive resources, episode transcripts, and more.
Until next time, keep pushing the boundaries, making smart moves, and turning your financial dreams into realities.
You've been listening to Money Mavericks, where Mavericks become legends.